Hello, welcome everyone. My name is Kanesha Lenore Jean-Baptiste Brown, and I welcome you to today's Financial Literacy and Wealth Empowerment Virtual Symposium series, brought to you by the National Alliance for the Advancement of Haitian Professionals. Financial literacy is the foundation for economic empowerment, stability, and generational wealth. This multi-part symposium series will break down key elements of professional and community finance into actionable, easy to follow sessions. From budgeting and debt reduction to investing, small business finance, and planning for your children's future. Each episode will provide practical strategies and culturally relevant resources tailored towards the Haitian diaspora. Today's guest is no stranger to financial planning. Samuel Danache has over 10 years of experience in the financial service industry, during which he has served and educated thousands of families. Through his work, he has discovered an important truth. Most people don't plan to fail, simply fail to plan. That realization fuels his mission to equip families with knowledge and strategies they need to build strong financial futures. Samuel provides world-class financial education combined with a customized implementation process designed to help individuals and families take practical steps towards financial independence. His passion is helping people achieve true financial freedom through financial literacy and smart planning. Before entering the financial services industry, Samuel spent a decade in corporate accounting and holds a bachelor's degree in the field. Today, he's a licensed financial professional in more than 30 states, allowing him to impact families across the country. Samuel's goal is to simply but powerful to change lives one family at a time and create measurable financial transformation within communities. Outside of his professional work, Samuel considers himself a missionary at heart and often says, God is my travel agent. Are you ready to start your journey towards financial freedom? If so, we'll pass the mic over to Mr. Samuel.
So thank you for the introduction. This is very exciting. I'm going to go through a lot of good things that's going to be very empowering that I might add. So the first thing is this. Why do you guys think that most people struggle financially? Would you say it's because of lack of money or lack of financial education? Most people will probably say the reason they struggle financially is because of lack of money, right? So for example, if someone, for example, is making over $50,000 a year, and all of a sudden they go from $50,000 a year, living paycheck to paycheck, now they get a raise to $100,000. The question is, are they gonna save that extra $50,000, right? We all know that most people want. That's why most people that win the lottery for over $100 million, over 90% in less than 5 years, they don't have anything to show for it. So financial education is the key. And that's why I'm very excited by this series and what you guys are doing here, which is very exciting. So I want to get into some things here. So we live in one of the wealthiest countries in the world. You can work hard all your life, but still retire poor. We do so much to raise our kids and see them finish college with a lot of debt. So we talk about that. The biggest expenses for the average American and Canadian are interest and taxes. Both are expenses that put money in someone else's pocket, right? Understanding how money works is part of taking care of your family. We all want a comfortable retirement, but yet I have no plan. And that's what you guys are going to get today. So my passion is financial education. And we just heard here, I've been doing this for over 10 years, because I truly believe the only path to freedom is financial freedom, to financial education. So now, I always say that most people are going to make $1 million in the US. And people always look at me like, what do you mean? If someone make $50,000 a year, let's say an average person started to work at age 25, and they were making $50,000 a year, right? In 20 years, they've already made $1 million. Now, the next question is, out of the million, how much of it do they have saved? For most people, it's maybe 5,000, some are zero, some are 10,000, some are 20,000. Now, let's say you go from 45 to 65, another 20 years, averaging 50,000, you make another $1 million. So you've already made $2 million. Now the next question is, how much of that 2 million do you have? It doesn't matter how much you make. What matters is how much you have left. And that's what we're going to be talking about today. So part of that is, when you look here, you see this is average income of a police officer, 60,000. In 40 years, they made 2.4 million. And average income of a doctor is about 240,000 a year. In 40 years, they made 9.6 million, but most of them still struggle financially. But why is that? Those are some of the different portfolios, different type of financial accounts that somebody can do, whether it's a savings account or a Roth IRA or college funds or life insurance or pension. Those are all the different ones. But there's 3 causes of financial distress. There's 3 potential things that can put you in a bad financial position when it comes to money. First one is a sickness. Second thing is when someone passed away. Third one is retirement. Let's talk about sickness first. Let's say, for example, you were to get sick. I'm not talking about disability. I'm not talking about anything like that. I'm talking about maybe you have a stroke, you have a heart attack, something happened where you cannot go to work. What is it that you have in place that will still pay you an income? I guess my question is, what is your income protection strategy that if you were to lose your income, you'll still get paid? That's a very important question to ask, because the number one cause of poverty in the US is a sickness. So what do we do with that? We have an income protection strategy that everybody should have something like that in place. The second thing is when someone passed away. Most of the time, you see the wealthy family, when they passed away, they passed wealth. But a lot of different families out there, when someone passed away, what do they pass? A lot of debt, student loan, credit card, car loan, all those things. So what do you have an instant estate that when something happened, there's an estate that been passed on to your family, to your loved ones, to your kids, where you're living some type of generational wealth. Third one is retirement. Right now, one of the biggest fear in America right now is the fear of outliving your money. Why is that? Because people are living long, right? Because back in the day, most companies used to offer pension. People didn't have to worry about retirement that much. But what percentage of company offer pension today? A very small percentage. Most don't, right? And Social Security, most people call it social insecurity, right? Because they don't believe it's going to be there. Guess what? Most people are afraid that they're going to outlive their money. When you go to Walmart or you go to McDonald's and you see somebody that's working there at 75 years old, 78 years old, 79 years old, the question is, are they working there because they want to or because they have to? So what is the solution for that? Maybe you have an index strategy. I always talked about there's the big difference between an investment and retirement. Investment, obviously, is something that is tied into the market, politics. Based on that, market going to go up or down. A retirement is something that is guaranteed, right? Would you go to Vegas and gamble with your retirement? Probably not. A retirement is something that should absolutely be guaranteed. So if someone has a 401k right now, which is one of the most popular retirement plan, it's very important to understand how it works. On a scale of 1 to 10, 10 being you can teach a class about a 401k, how well do you know your 401k? So let's learn about it a little bit, right? So 401k obviously is a retirement account. Before you even see the money, it goes into your 401k and it goes into what we call a variable account. What is a variable account? Variable account is when the market goes up, obviously your money goes up, but when the market goes down, your money goes down, right? But there's few rules about it. The first thing, a 401k is tax deferred. What does that mean? That means that you don't pay any taxes today, you're gonna pay taxes later, right? So let's say you invested, let's say 10,000 and I grew to 100,000. Would you wanna pay taxes on the 10,000 or would you wanna pay taxes on the 100,000? Would you wanna pay taxes on that little seed or would you like to pay taxes on the big harvest? But the 401k, you pay taxes where? On the harvest, because it is tax deferred. Couple rules about it. First rule in the 401k is called the 59.5 rule, where you cannot take money out of your 401k before the age of 59.5. But a lot of people find themselves having to take money out of their 401k before that age. And usually this is what happened. The first thing you get hit with is a 10% penalty, because if you're not 59.5 yet, and then the next thing is going to depend on what tax bracket that you're going to end up. Then maybe you're going to pay a 30% federal tax, or 20% or 15%. And if you're in a state where they have a state tax, like a California state like that, then you're going to pay an additional 10% taxes. So for most people, they're going to see a large chunk of your money being pretty much gone if they're trying to take money before that age. So now let's talk about it. Another rule is called 73 rule, right? Meaning, when you reach the age of 73, you are required to take money out of your 401k. It's called RMD, required minimum distribution. If you don't, you'll be penalized 50%. But 50% of what? So let's say somebody had 200K in their 401k, and their minimum distribution was, let's just say 50,000, right? And it didn't take that 50,000. If they don't, they'll be penalized 25,000, half of the minimum, right? So it's kind of damn if you do, damn if you don't. But now let's say like you age 65. Now you age 65 and you're able to take money out of your 401k. Guess what? There'll be no penalty anymore. But guess what? You still have to pay the taxes. You still have to pay the federal taxes, and you still have to pay your state taxes. But no one knows what tax is going to be in the future. Based on the national debt, maybe some people will say tax is going to go up, but no one knows exactly where they're going to be at that time, right? 1978, the tax is over 70% at that time, right? Most people don't know that. So what's some of the things? There's a lot of rules, a lot of regulation, the penalties and market loss and taxes. So this is like how the 401k work. And what we're going to talk about is, where can you put your money to make more than 3%? Why is that number 3% important? Because if the cost of living is going up by 3%, then I have to make sure that my account is doing at least 3%. Does that make sense? For example, if the cost of living for the last 6 years has been going up, can you go back to the same grocery store you went back 6 years ago and pay the same amount for groceries? Can you go back to the same school that you went to and pay the same amount for tuition? Can you do that? Probably not, because the cost of living is going up. But what happened to most people, wherever they put their money, they're not earning 3%. For example, people, are you making more than 3% in your checking account? Probably not. Are you making more than 3% in your savings account? Probably not. Are you making 3% in your CDs? Probably not. 401k, we don't really know, because I say they go by prayers, right? Meaning it go up and down in the market. So if you see here, you'll see that the market go up and down throughout that time. So we don't really know exactly where it's going to end up. Same thing with IRA, same thing with Roth IRA, same thing with stocks. Index annuities, obviously, most of them are doing more than 3%. Some life insurance, hypothetically, they're doing more than that. Municipal bonds, a lot of them are doing around 3 to 5%. College funds, obviously, are inside of the market as well. So now you know what account is potentially doing more than 3%, and what account is doing less than 3%. So now let's talk about taxes, right? So what account can you pay taxes and interest, and what account you don't pay taxes and interest? Obviously, checking account, even if it's 20 cents or $1, whatever the amount is, they expect you to pay taxes on that. Savings account, same thing. CDs, 401k, obviously you pay is tax deferred. You're gonna pay taxes. IRA, same thing. Roth IRA is tax free. Stocks, you have to pay capital gains. Index annuities, you have to pay capital gains. Life insurance, depending on how you take it out, potentially will be tax-free. Municipal bonds, tax-free. College fund will be tax-free if you use it for college. So there's really 3 buckets in terms of taxes. So paying income tax now or paying income tax later will be the 401k, the pension plan, the traditional IRA. Capital gains will be stocks, mutual funds, or real estate. And usually capital gains, you're in a lower tax bracket, tax-free. You have things like Roth IRA, municipal bonds, cash value life insurance, things like that you can look at. But here's probably one of the most important rules when it comes to money. It's called compounding interest. So Albert Einstein said, compounding interest, the eighth one of the world, he understands it, earns it, he who doesn't pays it. If you have student loans, welcome to compounding interest. If you have credit cards, welcome to compounding interest. By the way, on the bad side of things. But what if you wanted to having your money, your assets grow from a compounding perspective? So I'm going to explain it to you, the difference between simple interest and compounding interest. Simple interest, let's look at two different accounts. They both start with 100,000. They're both earning 10%, but one is going to be on simple interest and the other one is going to be on compounding interest. Okay? So in the first year, simple interest has 110,000, compounding interest has 110,000. Second year, something happened. Compounding interest has $1,000 more than simple interest. Why is that? They both started with the same amount of money. They're both earning the same amount of return, which is 10%. Why is that? The reason for that is because simple interest, you only earn 10% on the 100,000, regardless of what year you're in. Compounding interest, you're going to earn 10% based on how much you have at that time. So let's look at year 20, for example. Year 20, simple interest end up with 300,000, but compounding interest is already outpacing it by 672,000. Why? Because even if you have $300,000 here, they're going to credit 10% back to 100,000, but with compounding, they're going to put 10% of 672,000 because it's compounding, right? Let's look at year 40. Year 40, simple interest end up with 500,000. What do you guys think compounding interest is going to end up with, right? What do you guys think? Think about it. After 40 years, that 100K turned into 500K, but if it's compounding, look how much you're going to end up with. $4.5 million. For most people, it's almost too good to be true to believe that a compounding effect can work that way. And that's why Albert Einstein called it the eighth wonder of the world. So whenever somebody in investment, one of the most important things to be aware of is it compounding interest, right? Is it compounding interest? But now let's say you're going to invest your money, okay? And you want to know, what are my options? What's some of the options that I have if I want to go invest my money for any reason? There's only going to be three options. The first option is you can do a fixed account. If I put my money in the bank, savings account, CDs, it's a fixed rate. So let's say they're going to pay me 1%. You pay me 1%. Market goes up, what do you get? 1%. Market goes down, what do you get? 1%. That's called fixed rate. The second type is variable. Variable could be a 401k, could be stocks, could be IRA. When the market goes up, what happens to your money? Your money goes up. But when the market goes down, what happens to your money goes down? But there's also index. What is index? Index, when the market goes up, your money goes up. But when the market goes down, obviously your money goes flat. You never lose money when the market drops. But most people never heard of that before. Here's the thing. Most people have money in the bank earning 0.14 cents, 11 cents. And inflation, cost of living is going up by 3%, 5%, right? Here's how important compounding interest is. If I give you 1 penny today, and that penny double every day for 30 days, how much do you think you'll have by day 30? A penny double every day for 30 days. One penny, not 25 cents. 1 cent double every day for 30 days. How much money you think you're going to end up with? For some people, they might say 60 cents. But look what happened. Day 1, you have 1 cent. Day 2, you double to 2, double to 4, double to 8 cents. By day 15, you have $163. For most people, they quit. They think, oh man, this doesn't work. Guess what? If you wait 15 more days, then you double to 327, 655, 1,310, 2,621, 5,242, 10,485, 20,000, 41,000, 83,000, 167, 335, 671, 1.3, 2.6, $5.3 million. And you started with what? 1 cent. That's how powerful compounding interest is. Now, from a legal perspective, when someone passed away in the US, the first thing that happened is most of their assets is frozen. Checking account frozen, savings account frozen, CDs frozen, 401k frozen, IRA frozen. Why is that? When someone passed away, the reason they freeze your account is they want to make sure that you pay your estate. What is your estate? Your estate is your bills, credit cards, student loan, all those things that you have. Before your family receives it, they want to make sure those things get paid. So it has to go to probate. Same thing with stocks, index annuities. Some state, it doesn't go to that. Life insurance, some state they will go to that, but bonds and college funds as well has to go through that process. So as you're thinking about that, I should be thinking about what would it take for me to become financially independent? And the first step, and the first thing you're going to have to do is think about what is your FIN number, FIN. What is your financial independence number that if you have that number coming in every month, you consider yourself being financially independent? That's where you start. Because if you say, my financial independence number is $5,000 a month, and let's say you accumulate $500K, and that account is averaging, hypothetically, 10%, 10% of 500,000, that's 50,000. Now you can potentially live off the interest. So the first step in retirement is to figure out, what is my FIN number? Let's say your FIN number is $10,000 a month. Then maybe you need to accumulate $1 million. Now you can potentially averaging 10%. Because most people, let me see. I think it froze on me. Okay, you're gonna have to ask the question, how much money do I need coming in each month to be able to retire? What is that number per month? What is that number per year? Am I currently saving for retirement? Because retirement is not an age. Retirement is a pile of money. You could read the age of retirement, but if you don't have enough money, obviously you're not going to be able to retire. Am I ahead, behind, or am I on track? I currently have this amount of money growing for me right now. Based on these numbers, how big of a nest egg do I need? 100K a year, 2 million a year, whatever it is. So think about that. This right here shows how to get to $1 million based on an 8% hypothetical return. If you're 25 years old, that's what you need. If you're 45 years old, this is what you need. If you're 50 years old, this is what you need. This kind of gives you a roadmap. which is very important. But here's the question. As of now, here's a question we all have to answer. How many days forward could you survive if you stop working today? That is a question that we all have to answer, because we don't want to wait when those things happen and we're trying to find the answer. We need to be more proactive and trying to figure out, how much do I have right now? If they shut down my income, how long could I go without receiving an income? Let me close out on this. How to go out and build your financial house, okay? Because building a financial house, for most people, they think it starts with investment. But we all heard people that win the lottery, they had enough money, but they squandered all of it because they didn't have the foundation. What is the foundation? The foundation of the house is financial education, is learning how money works. If you take, for example, a wealthy person like Oprah or anybody out there, and we take all the money away from them, what will happen in less than 5 years? They probably go back exactly where they are. Because what? Because they have the financial education. Then after that, some people think, okay, I understand how money works, I need to go to investment. But let me ask you a question. If you were to get sick, let's say you have 5,000, and you say, I'm going to invest my 5,000. If you were to get sick, how long is that $5,000 going to last? So the next step is, what is your income protection strategy? What is your asset protection strategy? What is your family protection strategy before you get into the next step, which is retirement, which is make sure your kids go to college? Why is retirement before investment? Because investment is something, there's risk involved. So if you lose everything in your investment, you're still going to be able to retire. Your kids still going to be able to go to college. You have the income protection just in case, and you have the financial education. But what is the last step? Because most people are making their investment their foundation, which is why the minute they lose all that, the house is going to crash on you. But if you have investment there, you lose everything, you're still good. But what is the last step? Then the last step, which I don't do, you get with a trust attorney for that, is make sure, we call it estate preservation. What is that? Making sure you have a will, a trust, that all those things, all those assets we just talked about is inside of the account to make sure that you be in a good position financially and be protected in most states. So here's the question now. When is the best time to start compounding your money? When is the best time? When is the best time to protect your income? When is the best time to protect your assets? Because for most people, we always say, what's the number one nation in the world? The number one nation in the world is procrastination, right? One day turned into 1 month, 1 month turned into 1 year, 1 year turned into 5 years, to 20 years, to 30 years, to 40 years, and we still haven't got what we initially wanted to get. When is the best time to protect your assets? When is the best time to give your kids, which I truly believe in, to give your kids a head start financially? Because in a lot of community out there, our kids don't have a head start. They graduate with student loans. They graduate, basically, when they graduate with the student loans, before they start working, they already have pretty much a mortgage. They are behind. But what if every kid had a head start financially? By the time they graduated, they had some type of funds that was already there to give them that head start. Because in most community out there, we don't have the head start. Here's what happened. Your parents was working, maybe they were doing very well, and then you start at zero, and your kids start at zero, and the next kid start at zero. But some other community out there, what they're doing is they're always building on something. Maybe they left their kid $1 million, and the kids learn how to build that $1 million to 10 million. And the next generation take that 10 million, maybe to 50 million, whatever, right? So they're always building on something. So what is it that you have in place to give your kids a head start? Because guess what? The waiting game is a losing game. Thank you guys for having me here tonight. I hope I bring a lot of values, things with everything that you guys are doing. And I guess we can open it for questions.
Absolutely. Thank you so much, Samuel, for that presentation. That was very informative. And I'm really excited to hear what some of our viewers have to say about that. And I actually want to jump into this because I know that there's families who are listening to this and they're hearing financial investments, they're hearing generational wealth, college planning. So if a family is just starting their financial journey, what are the first steps you think that they should be taking? Like right now, what's the first thing I need to be doing?
So the very first thing I would say is change the equation of your money. What that means is, so for most people, when they get a paycheck, the first thing they do, they go and pay bills, right? And then whatever they have left, which is usually zero, they want to save. So the way you do it is when you get a paycheck, you pay yourself first. Make sense? So let's say I get $100 and I say, you know what? I'm going to pay myself $10. I pay myself $10, and then the rest, I pay bills. I pay everybody else. Because guess what? You're the one that worked for your money. Why you pay everybody else before you pay yourself? Does that make any sense? So it's not how much. A lot of people get caught up on how much. No, it's get moving. If it's $10 or $20, whatever it is, you build that habit first. And then as you build a habit over time, you look up and like you have a massive nest egg. Truly believe that.
Okay. That's important. Okay, so pay yourself first, folks. All right. We know in the Haitian community, many of our families work extremely hard and often support their family members both abroad and even here. So how can we start balancing helping family while still trying to build long-term financial stability?
That's good. I like that question, actually. It's controversial, but I like it. But here's the thing, right? I heard Mother Teresa said that when she said the best way to help the poor is not to be one. The best way to help the poor is not to be one. So if that's true, I'm not saying we are poor, but if we're helping people, we cannot even help ourselves, then when we run into a financial issue, are we going to call those people back in Haiti and tell them to help us? Right? So there has to be a balance. Okay? There has to be a balance, right? Because if there's no balance, by the way, some people think they're helping. I'm not saying we need to help, right? Because things are a little bit better for us here. But some people are actually hurting people there. Because now they become so dependent on everything that you're doing, they're not thinking about anything they can do for themselves. So what I would say is balance it out in that sense, but take care of yourself first. I think a lot of people are helping other people first, which is noble. And it's very Christian-like, which is a good thing. But at the end of the day, you have to put your mask first. When you get an airplane, do they tell you put the mask on everybody else first? Or do they tell you put your mask first, even if you have kids, baby with you?
Yes.
No, if you don't have your mask, you can't save anybody.
Oh, understood. And that's actually the first analogy that I thought about when you were saying that, right? So that's very impactful and helpful. I would say, okay, other than paying ourselves first, that folks need to start doing, you have done this work across the nation. And so when you're sitting with families, what are some of other things that you're seeing that they're making financial mistakes with outside of not paying themselves first? Like, what are some of those practices that we're all engaging in that we can do better with?
I think one of the one that I see a lot is they accumulate too much debt, and a lot of the money are going toward debt versus going toward building wealth, right? So when you look at the different class in terms of from a financial perspective, purely just financial, the poor people, they think money is built to pay bills. Oh, I gotta pay my bills. If you sit down with somebody who's poor, mentally, I'm not even talking about how much money they have. They think about, I got to pay my bills. I got to pay my bills. I got to pay my bills. But middle class is thinking about, I need to get more liabilities. I need to get a nicer car. That's another payment. I need to get a credit card that I'm going to have a big balance on. That's another problem. Because what's that doing to you? It's eating your future. Because that same exact dollar that you're putting in debt, because student loans, we can't really control that one, but the other stuff could have been money that been compounding for you in the market. But wealthy people, they think about asset, meaning what is an asset? An asset is something like I put $100 somewhere and it's making babies, meaning it's making $10, right? A month or whatever it is, right? It's making 10%. So they think about money in terms of making more money with that money. So it's a psychological difference when you look at somebody that has like a middle class or poor mindset versus a wealth mindset. And the other difference is it's a massive one, but it's all psychological in terms of what I've seen. People that struggle financially, I'm not talking about money. Some of them make more money than others. They have a scarcity mindset. Okay. They always think, and I grew up in that environment, so I understand it very well. They always think things are running out. They don't understand we live in an abundant world. Nothing is running out. It's like you go to the ocean, instead of going with the bucket, you go with a teaspoon. You think it's gonna run out. I'm getting from this person. Because I heard a story from Bill Gates. He was having an interview with a lady, and the lady asked her, like, what is the secret of success? He said, yeah, I'm gonna answer that question. But before I answer the question, he gave her a blank checkbook. And he said, you can write whatever you want in that checkbook. She said, no, I don't really want to do that. And he took it back. He said, that's the secret of success. I just give you a blank check that you could write anything you want, any number you want. I'm a billionaire with a B, multiple billions of dollars, but you didn't write anything. You know why? Because most people are afraid of success. That's what I've seen. Those are the primary ones.
Yes. So that's actually resonating and sitting with me because, yes, people are afraid of success. And I think some of that is related to also being afraid of failure. So you don't want to do this thing and it doesn't work out. And something that I've seen, I want to hear your thoughts about this a little more, and especially within our communities, the Haitian community with our elders, they love a good savings account because they can see the money, right? Yeah. And so when it comes into like investments, is there any type of like entry level to investments that somebody who might be afraid to do it, or maybe they're not ready to get that rental property, right? What are some smaller ways that we can invest and see our money expand that might not be as risque, such as bigger investments?
Good question. And I agree with you. A lot of immigrants, they just love looking at their money in their account, like a pull to view, right? It's got, yes. Like people don't know, if you've been to Israel, you have the Dead Sea, right? The reason it's a Dead Sea because there's water coming in, but there's no water going out. We have the Dead Sea, and you have the other one. I forgot how they call it, but this one actually have a flow, have an inlet and outlet. That's what most people do. So most people who are looking at their money in their savings account, they're looking at the Dead Sea because the money's not doing anything. And when the money is not doing anything, you are losing money on a daily basis because inflation, the cost of living is going up. Remember the time $100 was a big deal? Remember when $500, man, you get $500, you feel like, you feel like, man. Yeah. Exactly. Right? But money is losing this value completely. So the $500, you have to have way more now to feel like you have something. I forgot what was the main question you asked about.
Is there like a small amount? What's like a low risk investment that somebody
I would say two investment. I would say in an index. The first one I would say is a high yield savings account. So there is what they call them, the online account that somebody can set up, high yield savings. I recommend those potentially if that worked for that person. And index accounts. Index accounts, I'm not talking about index funds. Index account, they don't lose money. They only make interest based on what the market do that year, but you can't lose your principal. Those are two options I would say absolutely to be thinking about. But we definitely need to be thinking about multiplication. But those two will be definitely the account to start with. And I would say the savings account, it shouldn't be with the same bank you have your checking account. Because if it's that way, it's not a savings account. It's a transfer account.
Okay, makes
Yeah,
sense.
yeah.
So you say it's a transfer account. So what are the benefits of having a separate savings account with another banking system other than the one that you have your checking in?
You make it a little bit harder to be able to transfer the money and to spend it. And usually, when you see something a lot, you tend to have ideas of where you need to spend it next. If you've been looking at your account on Tuesday, Wednesday, Thursday, Friday, by Saturday, you're in the mall because you're like, dude, I'm rich. I got money. I got 15K. I got five, whatever it is. I'm good. So the fact that you have a separate account that you don't look, by the way, I did that I still do that today. I have an account that I never look at I won't say never, but I just set it, forget it kind of thing. It's automatic. They just take it out. I don't think about it. I rarely look at it. And we have a regular account, like a checking and savings, where you're checking maybe every week, whatever. But that separate account, I don't think about it at all. It's a true, I never believe in emergency account, because if you have an emergency account, you're going to have emergencies. I will believe in opportunity account. If an opportunity arises, then I can potentially, it could be a vacation. Doesn't have the opportunity to make more money. Could be anything. Yeah, that's how I would start.
That makes sense. Okay, so what actually fuels your passion to do this work? Because you're investing, you're financial literate. What is the thing that makes you want to make sure other families are as well?
I think for the first thing, it started with me. I mean, obviously, I'm originally from Haiti. I came here on a full basketball scholarship, played college, did study accounting. And I was thinking to myself, is this it? Just go get a job and
Yes.
then wait when I'm like 7 years old and have some money in my pocket when I'm past my prime? I said, no, I don't want to do that. I'm not saying maybe it's work for other people, but I didn't come here for that. So I have to figure out what is not the secret, what is the information that I need to gain to be able to become financially independent. So I become obsessed with the idea of being financially independent, because what most people don't know, even though I did study corporate accounting, I did all those things, they don't teach you about money. Like, I was a corporate accountant. I was really good at helping the companies. But when it came to my personal finance, my wife is a nurse and she was the one doing our finance. Does that make sense? That doesn't make any sense at all. But guess what? I did good with the companies. So I started learning about those things. I started, okay, how do you do it? They don't teach it in school. They don't teach it in high school or college or at your job or things like that. And then I started reading a lot of books about it. And I figured out how to do it. And I've helped thousands of people to do the same thing, because I hate not being free. And now, and way before than that, I don't like to see other people in that position where you meet somebody in a Walmart, they're like 73 years old. Why are you working here? Because I don't have any money. And they've worked for 40 years of their life already, but they don't have any money for retirement. So I think all those different aspects is something that's been very disturbing for me, because it really disgusts me to the highest level that we in one of the greatest country in the world in terms of financial, and then still people are struggling financially because we're more consumers than we were investors. We know how to consume things, right? But we're not investors. And obviously we have to learn that, even if it's baby steps. But what I'm really good at is helping people implement, because people love education, which is awesome. But we have to get to implementation. If you're a Christian, you read the Bible, but you tell people, I'm reading the Bible, I'm doing this, I'm doing that, but I cannot see it in your life. What's the point? We have to implement. So that's where I'm passionate about helping people implement. And I really want to work in my own community, the Haitian community as well, because I think we should be way further as a community in terms of reputation than we are right now in the other communities. And that's why I'm here right now, to be honest with you.
Absolutely. And I just got a couple more questions in wrapping this up. And like you're saying that we are a very consumer just nation. And I think some of the things that we've also seen in diaspora is a lot of times we're just managing two households and that's just been our reality. What are some, I believe that there's a difference between needs and wants, right? What are some wants that we are overspending money on right now that people can start cutting to so that they can shift that money towards investment?
I don't know if everybody would like this one, but I just have to tell the truth. There's something I call the electronic income producer. The electronic income producer. What is that? It's called TV. That's the
Mm,
number one thing that's taking money out of your pocket. The amount of time that people spend watching TV, if they put that same amount of time reading books and learning and implementing, they all be wealthy. All of them. Most people, they spend too much time. Nothing should be zero, but 6 hours, 5 hours a day just watching every shows on Netflix is robbing your future. It's actually robbing not just your future, your potential. Because to me, you always want to find out what is your potential. Like, how good are you? We don't know, but let's find out. Let's read the books. Like, it's funny in your pursuit to financial independent, you being introduced to a better version of yourself. Because if you're always thinking about bills all the time, you can be the best version of yourself. You can pray really well. You can't. You all you're thinking about is your next. I'm in that situation. It's terrible. It's just not good. But when you get that out of the way, you're gonna be introduced to a version of yourself that you didn't know that existed. So my answer to that question is: what's something to cut out? TV. What's something to cut out? Social media.
yes.
A lot of things that you need to cut out, those are like time wasters, not even money wasters. To me, they were time wasters. So if I take that same exact time, because time is money, yes, but most people don't know. If I'm making $25 an hour, for example, and I bought something that costs $200, I just bought it with 8 hours of my life. You understand that, right? So you don't buy things with money, you buy things with your life. So if you start looking at it from that perspective
Yeah.
and you understand time is even more important than money because I can use the time to make more money if I start building my skill in something that I'm interested in, potentially. My interest was I want to help people become financially independent. I don't want to do anything else. Throughout my 10 years, I've had many people tell me, do this, to that. I said, no, I don't want to be a jack of all trade. I want to be a master of one. This is what I'm going to focus on. I don't care how much money you're making, whatever you're doing. I want to be a master and continue to master this for the rest of my life. And that's what I want to do. But if you're watching TV, you're distracted, you're not going to find that thing for you because you're not spending enough time like fighting that your purpose or whatever it is because you're constantly distracting yourself from your future because you don't want to face it. So my answer
Mhm.
is not money. My answer is time.
Yeah.
That's
That's
my
profound. And then also considering when we're watching all these advertisements or we're on social media, we're paying somebody else. While we're losing our time, we're paying someone else. Okay. And so my final question is, so you said earlier, a lot of it is a mindset and how we think. So for the person who's listening to all of this, they've been watching the series and they're still like, Samuel, I don't have the money. Okay. I don't make enough money to be an investor. What are your closing comments to speak to that audience member?
Oh, that's a great question. Let me try to speak to that person, me 10 years ago, because I was in that shoes. Because to me, like I had a great, good family and things like that. But I grew up in an environment when I was growing up, I'll never forget this. I had a mindset that I developed in the area that I was in that when things are going good, I always thought something bad is coming. You know that? Can you believe it? Things are too good. I was like, man, something bad must be coming.
Yeah.
Things are not supposed to be good. Like I grew up literally. So it took me some time to wash out that part of it from a mindset perspective. But here's what somebody has to do right now that is listening to me. If it was impossible for you to fail, what would you be trying? For 1 second. I know you think everything is impossible, you can do nothing, you have bad luck. By the way, you rain on the poor, you rain on the rich. We all have problems. Okay. But if it was impossible to fail, what would you be attempting? And when you answer that question, and it takes a little time, you have to sit down. Most people don't want to sit down with themselves. That's what, the minute they sit down for 1 second, they go to social media. Okay. You have to turn your phone down to airplane mode or something.
Yes.
Sit down, and then there's gonna be an urge to go to the wrong habit. If a cat want to be, the minute a cat make the decision to become a lion, they have to lose their appetite for rats. Meaning, they have to change their habits. So if I'm thinking, okay, if it was impossible to fail, what will I be attempting? And I find out what is it that thing. Now I have to develop new habits. What are those habits, that things that I'm talking about that I want to achieve is going to ask of me? And I understand what those habits are, and I start doing those things. I start going to the gym. I start reading books. I start doing things, and you'll be shocked how much you improve overall. Like me, I do a lot of public speaking and all those things in front of a lot of people. If you told me that 50 years ago, I would not believe you at all. I used to be an accountant. But to reading books, listen to different tapes, that person who said they want it, let's see how much you want it. Turn your car into university. No more Lil Wayne in your car. When I get in the car, right, I need to be listening to some type of like personal development tape for the next 3 years. And I promise you, if you do that in 3 years, no one's going to recognize you. If you change the book, by the way, you're going to lose some people too, because when you start growing, some people don't like that part, but God has a purpose for you. He's not making the most friends. He's telling you, I have when you have something inside of you that's telling you, go to this, and you like push it down, it's never going to go away. It's never going to go away. If you have that urge because you're able to complete it. I don't have the urge to become Justin Bieber. I don't have the urge to be Prince or Michael Jackson or this. Everybody have their own urge. What is your urge? And if it was impossible for you to fail, what would you be attempting? And if you answer that question, you change your habits, and you're gonna have fall down. It's part of it. People, like, the biggest mistake people make is think they're not supposed to fail. You're supposed to fail. Like, the best thing my grandfather told me is this. He said, Sam, you're gonna fail. I said, what do you mean? I don't believe it. I'm gonna be perfect. I said, dude, at 11 years old, told me this. So you're gonna fail. And that was the best thing he ever told me. Guess what? Everything that I enter, I expect it to be hard. I don't expect anything to be easy. If I get married, I expect it to be hard. Like, there's gonna be good times, there's gonna be challenges. If I have kids, which I have, I expect it to be hard. I enjoy the good times, but I don't think it's all fairy tales. And I started a business, same thing. There's gonna be challenges. Just because there are challenges doesn't mean you have to develop that idea of being a victim kind of thing. So
Thank you so much. That was so insightful, very powerful. A lot of my key takeaways is just our mindset, our mentality, and just being brave towards a liberated future. So thank you, Mr. Samuel Danache.
three things that you take away from this, like three things that you got out of it.
Okay, so now you're the moderator.
No, I'm kidding.
Actually, you know what? I'll share my three things.
Yeah.
A lot of it takes just bravery, right? You just have to be brave. The second thing, in addition to that bravery, is that you got to be okay that you won't succeed at all things. That one really came out to me in regards to investments, right? So It's okay if you go into some small investments and maybe they don't turn out the way that you want them to, but that's not a reason for you not to do it and just to continue it. And the third one that I'm walking away with is plan for my future as hard as I'm planning for my present. You gave a couple of examples about people who are in their elderly age, who have worked so long. And that's one of the things that breaks my heart. People who've given so much physical labor just to the work, to their field, and then they still don't get to rest in that work. And so as I make sure that I'm planning for what I want to wear that day, what I want to eat that day, I want to make sure I'm wearing good stuff in the next 20 years and I'm eating a good meal in the next 20 years too. And so those are my key takeaways. And I really hope that our audience is able to really pull some of those gems. Thank you so much for being here with us tonight. Thank you so much to our partners at the College Cafe. Until next time, everyone.
Thank you, guys. Thank you for the opportunity. Have a good night.